Hey, it's Michael Saul. This is the follow-up video to the January effect list. This is managing the January effect list. It's 8:12 p.m. on Monday, January 2nd, 2012. Whoa! Happy New Year, everybody. Hope everybody had a wonderful and safe New Year, and everybody's looking forward to a great 2012. So, here's a disclaimer. By the way, I have strep throat, so this is not going to be a long video. Please pause this, go back to read it again. Okay, this is just education. Okay, it is not advice to buy or sell any securities, options, futures, currencies, or the like. Here's the CFTC rule, which says hypothetical or simulated performance results have certain limitations. Okay, so read that. So, when I did the first video and then sent out the list a couple of days later, there were no initial stop losses talked about in the video or with the list, because no stop losses were given because entries were unknown until the close. All right, so if you wanted to use stop losses, then you had to use them based on your own discretion, which of course the entire list has to be played at your own discretion. So is this reckless? Well, there's no stop losses. How can you trade without stop losses? The answer is no, because as I talked about in the first video, the best way, in my opinion, to play the January effects is with a basket strategy and use a fixed percent of your port on each of the stocks you decide to trade. So let's say you do your research and you come up with 10 stocks that you like for the January effect. Well, if you're going to leverage, then you could put 20% into each stock if you wanted to leverage. But if you're not going to leverage, you can put 10% into each of the stocks. And if you want to deleverage, you can do 5% right into 10 or whatever. Now, I gave a list of 20. All right, so I'm going to use those 20 as an example. 10 of those 20 stocks were Dow stocks. Okay, so let's say, and I talked pretty specific about not using leverage. So let's assume it's 5% into each stock. Okay, this is for documenting purposes. And remember, like I said in the video, like I've written a number of times on the blog and stuff, this is, just my way of doing it so I can track it. You see, when you're a super guru, you just make up your entries, okay, and exits, and you make sure that your entries were at the low and your exits were at the highs, okay? That's, I have to sleep at night, all right? I can't do that. So, do I like trading these as mechanical systems? Absolutely not, okay? But that's how it's going to be documented. And it's one trade, okay? Now, why don't I like mechanical systems like this? Why don't I like to use this as a mechanical system? Well, for example, on the 27th, which was the entry for 2011 into 2012, we traded higher into the close. I don't like buying when we close at the highs. Matter of fact, on the one of the stocks that I gave on the list was RIM. I said one alternative would be wait for a dip, and I'm counting it as the next day's close as the entry because I wrote it out, okay, with plenty of time. But, really, I probably should have said wait for a dip on the whole list the next day. But then it's confusing, so I did it with just RIM. But, that's why this isn't a mechanical system, and it's surely not a mechanical system with managing it. All right, so anyway, back to the fixed percent of port. So 10 of the 20 stocks are Dow stocks, all right? So let's say you took your whole portfolio and you came up with 10 Dow stocks that you like, and you came up with 10 other stocks, and you put 5% into each of the Dow stocks. Okay, now you're risking 50% of your port on the Dow stocks. Well, yeah, you had a chance to lose 50% of your port, but only if those 10 Dow stocks went to zero. I mean, could it happen? Obviously. Okay, a big nuclear attack or something, or the end of the world. But more than likely, if those 10 Dow stocks all went to zero, there would be bigger things to worry about, like where you're going to get your next meal, or how you're going to feed your family, and where we're going to go harvest food from, because it's probably a real bad situation out there for the Dow stocks to just go to zero in the time frame of December 27th to January 6th. All right, I mean, I'm not talking about eventually and forever. I'm talking in that little window. Okay, so you got to keep that in mind. Now, does that mean that they all can't go down 10%? And yeah, and if they all went down 10%, you would be down 5% on your port just on the Dow stocks, which would suck. And more than likely, if the Dow stocks are getting battered, the other stocks will get battered as well. All right, but not using stop losses is not a big deal because you're still defining your risk by using a fixed percent of your port. Look, if you took the information that I talked about in the presentation, you went out, you found two beaten to crap stocks that were trading at 2 cents, and you put all your money in one and all your money in another, and they went to zero, then yeah, you could lose it all. But that's not what I tried to convey when I was, talking about how to trade the January effect. Okay? So anyway, so that's the deal with no initial stop losses. Now there's 4 days to go. Okay, 4 trading days: Tuesday, Wednesday, Thursday, Friday. All right. Now the mechanical system ends on Friday at the close, or if the stocks are up and the S&P is up at noon on Friday. All right. Now that's the mechanical system. All right. You need to design your plan now, how you're going to trade these. You need to set a stop loss now. Yeah, well, you didn't put stop losses in the beginning, right? But now you have to say to yourself, do I want to risk a lot of downside if the year starts and craps out? Okay? So, where will you trail your stops? Where will you exit? And will you be able to live with it? That's what you have to say to yourself. So, this is an example. This is HGSI. The mechanical entry, which are these red arrows. All right, I'm sorry for all the lines. I'm going to try to make sure I'm pointing everything out. But the red arrows were the mechanical entry on the close. Okay, the initial stop below the lows of 651. That's logical. Okay, that's the lows of the year. So obviously, if you're looking for a bounce and it goes to new lows, it's obviously not bouncing. So that may have been an initial stop. Doesn't have to be. It just may have been. Maybe, you like this stock and you just can say, okay, I'm risking 5% of my port on it or whatever, or 2% of my port. Nothing saying you have to divide 20 or 10 stocks or however many stocks you do with your whole port. Maybe you picked 5 and you said, I'm going to throw 5% each in, and if they all go to zero, I'll lose 25% of my port. But they all have to go to zero, obviously, to do that. All right? So whatever it is. So that's one place where you could put your initial stop. Now, we went down one day and we started to turn. So now you can see the close of last Friday was 739. So the stock's up a bit. And then you have resistance right here at 775. So now this low is 689. Would it make sense to put your stop below there? Okay, how much could you trim? Well, you could trim 38 cents on a $7 stock. That's 5%. Okay, that's so somewhere under there maybe, maybe you could trim, go down to maybe 679 or whatever it is, or maybe you could leave it below the 651, whatever it is. But what are you going to do as it approaches resistance? Okay, now as it touches 775, no, maybe as it gets to the high 760s into the 770. All right, so let's say it gets to let's say it gets to 777. So now you're up 70 cents, which is almost 10% on the trade. Okay, are you going to lose from there? I don't know. I mean, I would hate to give back that gain. All right, so you may want to trail your stop. You may want to go to break even, or you may want to lock in half the profit, something like that. Because if it keeps going and it gets above this 775 resistance, you got the 50-day moving average, which may be a spot where you may want to take out the rest of it, take out all of it. It's up to you. Okay, so I'm sorry. So that is. This is just one example of, and I don't know if this whole chart is showing up in here. I'm not happy about that if that's the case, but whatever it is, you can see most of the mark-offs here. All right, so anyway, so you have to always say to yourself, am I micromanaging this? Am I moving the stops too small? Well, maybe moving the stops to break even here may be a little too tight. Okay, am I moving them too tight, not too small? Okay, so. But maybe a push up here to 775, up to here. I keep doing that because I keep thinking I'm on the chart and it'll pull up the crosshairs. But maybe to 775, you may say, you know what, I don't want to lose from here. I don't want to lose from here. Okay, 70 cents. Do I want to take profits? Maybe it'll keep going, but I sure don't want to lose from here. Maybe I'll take a piece off, and then maybe if it goes back, I'll make half. So, if I'm, whatever it is. Okay, so I'll make a little bit on it. All right. Now, what else? Well, there are some stocks that were cheap. I don't know what stocks you picked, but on my list, there were a couple of stocks that were, in the dollar range or slightly above $1, like CWTR and PNSN. Okay, so what do you do with them? You really going to put a stop on that? I mean, like I said, it doesn't matter if there's a stop or not if you're doing the equal percent port risk. But now that it's moved, you may want to say, hey, you know what? I may want to adjust my stop. What happens if you get a big move in one of the stocks? What happens if it's a wonderful move that starts the beginning of the year, and some of these stocks get big moves? Well, there's a famous saying, when the ducks quack, feed them. You may want to do that. You may want to take profits. You may want to move stops. It's up to you. It's your plan. And what happens if the market just can't get going? All right? Sometimes it's better to bail out than to sit around and let it just, oscillate around and then go the other way, and you're sitting there going, oh, I should have got out when it was up there. So maybe if the first couple of days of the year we're not going anywhere, not doing much, it's rotating, maybe you decide, hey, you know what, I'm going to either tighten up my stops real tight or just get out and move on to the next trade. Or reduce my risk so low that if every single one of them went to zero, like, for an example, just saying for an example, okay? Let's say you went all in, you allotted 5% to 20 stocks that you picked, okay? And it's not going much and not doing much, and you're about break even or maybe a little bit up. And you say to yourself, you know what? I'm going to reduce everything till it's only like 0.5% risk. So if every single one of them goes to zero, then I'll lose 10%. And they all have to go to zero for that, right? Otherwise, maybe they'll, and like I said, if depending on what stocks you picked, but if some of those stocks go to zero, there are bigger problems in the world, right? Some of the Dow stocks go to zero, okay, in this shorter time frame. But maybe you decide that. Maybe you say, hey, it's stalling out. You know what? I'm just going to reduce my risk. Maybe I made, my commissions back, or, maybe I made a little bit. And you know what? I'm moving on. And, if it goes from here, hey, I'm still in a position that I may capitalize. I may make a little bit more money. But if not, I can't get hurt. So, I mean, look, protecting your capital is the first and foremost, most important and imperative part of your trading plan, right? So, I know some people, they may look at other lists and go, well, look how good they did, and, Tiny's list. And I mean, my list was just stocks that I came up with. The point of this exercise was for you to look and come up with your own stocks based on the education. And I know some people have done that because they wrote me. They're not taking all the 20 stocks I gave. They're not following blindly. And I'm not saying that if you did do that, you'd necessarily follow blindly. But some people are coming in saying, okay, I got my stocks. I'm going to take a little bit from here and a little bit from there. And I'm going to use some, one guy wrote me, said I'm going to use some of the stronger stocks of the year to see if they get a little push into the end of year, new year. I mean, it's your trading plan. It's your money. All right? So that's it. I will do another update. Probably not by video, but you need to check the blog at tinystmv.blogspot.com. Sorry if I was a little off tonight. I said in one of the takes I did, I have strep and I just started the antibiotics, so I'm a little hazy here, but I wanted to get this out as the year started. All right? Have a great trading week, and don't forget to check the blog for any and all updates.